Hello friends, welcome to the course on accounting and financial management for bankers. So in this session, we will mainly see the basic accountancy procedure. See, introduction part about the accounting concept. What do you mean by the accounting concept? See, accounting concept are the basic assumption or condition on which accounting is based. So what is accounting concept? So these are the basic assumption. This is the basic assumption on which we can say these are the pillar on which accounting is based. So these are the assumption on which accounting is based. The alteration of any of the basic concept would change the entire nature of financial accounting. That's why we have to follow the basic accounting concept. There are accounting concept at a recording stage and at the reporting stage. What do you mean by recording stage? See, in the beginning, we learn about the recording. Recording means what? This is the initial stage in the accounting, and reporting is the final stage, we can say, into the accounting. In case of recording, we simply do the entry of the transaction. In case of reporting, we prepare the financial statement, we do the interpretation of it. That is called as the reporting. Okay. So we simply say recording means initial stage and reporting is, we can say, the final or the last stage. Okay. Now we are having some accountancy concept. At a recording stage, we have cost concept, money measurement concept, the business entity concept, realization concept, the dual aspect concept, historical record concept. However, with respect to the reporting stage, we are having going concern concept, the matching concept, accounting period concept, convention of conservatism, convention of full disclosure, convention of materiality, and convention of consistency. So these are we have to see with respect to the accounting concept. So one by one we will see. What do you mean by the cost concept then? See, cost concept. Assets are recorded at their original purchase price. That is what the cost price. So what do you mean by the cost concept? See, we are doing, for example, we are having the book of account. When we are writing into that book what we have purchased, right? At that time, we record whatever the purchase we are doing, we must record it at a cost price, right? Means what? Regardless of the changes into the market value. See, through example, you will get better idea. For example, land was purchased for 20 lakh. It is recorded at that amount even if its market value increased to 25 lakh. See, this is the, for example, book of account of a company, and the company owner has purchased some land, and you are the accountant, you have to do the entry, right? When you do the entry of a purchase of a land, you will record the cost of 20 lakh, right? Once you purchase the land, the value of land become 25 lakh due to the some conditions. Market value is 25 lakh, but you should not record the current market value. You should only record what is the value at which you have purchased, right? So the original purchase price you have to record into the book of account. That is called the cost price, is nothing but the cost concept. Okay. Now how we can apply that cost concept? See, fixed assets are kept at the cost of a purchase and not at the market value, which is the basic concept, right? Every transaction is recorded at the present value and not at a future value. Present value means what? Simply the cost at which we are purchasing that asset, right? We will not consider the future value, only the current value or the price at which we are purchasing, that only should be recorded. Unrealized gains are ignored. We will ignore whatever the unrealized gains. For example, what if we got some profit, right? For example, if we sold the land for 50 lakh rupees, right? We have received the 50 lakh rupees. We will not take into account whatever the future gain we are receiving from that property. That means simply whatever is unrealized, imaginary thing, the gain which will come into future, which are not realized, that we have to ignore. An item that has no cost should not be taken into the book. For example, if your friend has gifted you one machinery for your factory, that is at no cost you received. So as per the cost concept, the items which received at a free of cost or at a no cost, that should not be recorded into the book of account. Okay, so this is what the cost concept. So only the key point. What is the key point? You have to remember key point here with respect to the cost concept, that the only we should record the original purchase price, that is the cost price we should record. Next, money measurement concept. So the transaction that can be measured in terms of money that only should be recorded. Okay, what is the money measurement concept? Simply the transaction which you are able to measure in terms of money. For example, very simple. Through example, you will get idea. See, employee skills are important but are not recorded in the financial statement because they cannot be measured in terms of money, right? I have a lot of skill. I can speak very good, right? I have the good talent with respect to the speech competition, right? I have good talent in the ace writing, but that is not important, right? Whatever task is given to me is important. So whatever the employee skill, these are obviously important, right? But we cannot report that into the book of account. See next example, health of the proprietor or the manager is not taken into the book of account, although it may have a great impact on the business. So obviously, if a manager is not healthy, he become the sick, it will impact the business. Still, we will not write into the book of account about the health of the manager or the proprietor, right? That means there are something which must be recorded only in terms of money, called as the money measurement concept. What is money measurement? The things or the transaction which can be measured only in terms of money, that only we will record into the book of account. Next, how it will be applicable? See, we do not include any inflation or the deflation in the value of any asset. See, what is inflation? Inflation means general rise into the price of a commodity. Deflation means general decrease into the price of a commodity. Is called inflation, deflation. Right? So we will not consider about inflation or the deflation in the value of any asset. Right? That is what whatever the things, the transactions which in terms of money, that only we will record. While recording, we will ignore the inflation, deflation. We will not consider time value of a money, right? That means what? We are rejecting simply the inflation, deflation while recording in the book of account. All the transactions are recorded in quantitative term and not a qualitative. For example, I have spent 50 rupees to purchase 1 kg of rice, that I will record into the book of account, but I will not record what is the quality of that rice which I have purchased, whether it is a basmati rice, whether it is a kollam rice or right. That means what? The quantity only recorded, not the quality. Okay. So what is the key point here? In case of a money measurement concept, what is it underline? Only you have to remember that the transaction which are measured in terms of money, that can only be recorded. Next is the business entity concept. It is very simple. See, business is the artificial person. However, business is separate from the owner. For example, simply, I will take the example of say the Reliance industry, right? Reliance industry is separate than the Ambani. This is what the business entity concept means. What? When we write transaction into the book of account, we will separate that business is different and the person is different, right? So the business is a artificial person, however, is separate from its owner, right? Remember, what is business entity means? Business is separate from its owner. The capital contributed by its owner is a liability for the business. That is very, very important for exam point of view. See, what do you mean by the liability? See, you are at a very initial stage, right? Liability means what? You are liable to pay. You are liable to pay, right? For example, in a bank, you are sitting in the bank, right? So it is suppose the bank, right? People deposit money. People deposit money, right? So deposit money. So anytime they can withdraw it, means we have to pay as a bank. We have to pay. So deposit is a liability for the bank, right? People take a loan from the bank, so they are liable to pay it to the bank, right? So it is asset for a bank. So money which is receivable, always remember, receivable are the asset and the payable, these are the liability. So for a bank, what is receivable? For a bank, loan are the receivables, that's why it is asset for a bank. For a bank, the deposit bank is having, which bank have to pay, repay to the customer, that's why it is a liability for the bank. Always remember. Okay. So in the same way, I have to say, see, if person A has started the business, initially he has invested 5 lakh rupees to start a business, right? So 5 lakh rupees which he has invested, it is a capital for his business, right? So when business runs profitably, that 5 lakh must be get back to the person who has invested, that is called as the capital. So always remember, capital is always the liability. Capital is a liability, right? For the business, for business point of view. Okay. So one equation you remember, asset is equal to liability and capital. Asset is equal to liability plus capital. Generally, asset is equal to liability, but capital is also the part of liability. That's why we can say asset is equal to liability plus capital. Now, see, profit is a liability when loss is an asset. How we can say that profit is liability? See, yeah, as a business point of view, if a business generate the profit, right? So who will enjoy that profit? That profit must be given to the shareholders in the form of dividend, right? So we can say we have to pay it back. That's why we can say the profit is a liability. However, whenever if the bank got loss or any business incur the losses, in that case what will happen? In that case, whatever the losses incurred, for example, in the current financial year, the for say the Punjab and Sindh Bank got say the 50 crore of a loss. So from where that loss will be recovered? That loss will be recovered from the capital that that bank or the business is having. So for example, they are having 1000 crores of the capital. If they incur the loss 50 crore, now they will only they will have only 950 crore as the capital. They will only, right? Now what do you mean by it? Capital got reduced. In the beginningly, I have already told you that capital is what? It is liability. So liability reduced. That's why you can say loss is an asset. You have to note it carefully, right? I repeat, see, very simple thing you have to remember. Profit is liability. Why? Because profit business have to repay as a dividend to the shareholders. Loss is an asset. Why? Because if the enterprises went into the losses, that losses are recovered from the capital. And I have already told you that capital is a liability. So reducing the liability is what? It is asset. It is the asset. That's why in that way you have to treat profit is a liability and loss is an asset. The concept is useful at the time of closing of a business for determining the payout to the various shareholders. So basically, business entity concept is important. Why? Because see, we are separating the business and its owner or the promoter. Right? If business closes down, how their owner will get their shares, right? Or their profit or whatever they have to get, right? So at the time of closing down of business, that business entity concept is useful. Next is the realization concepts. What do you mean by it? See, revenue is recognized when it is earned, not when the payment is received. It is very, very important, right? So when we will recognize revenue when it is earned. For example, you will get it. See, if a company sells goods in March but receive payment in April, and revenue is recorded in the March itself. See, sales happen in March, right? But the payment received, they received the payment in April. Still, whatever the revenue we have generated, we will recognize it in March month itself, right? That is called as the realization concept. Remember, it is very, very important to know that the revenue is recognized when it is earned, not when payment is received, right? For example, you get company sold in March, payment received in April. Still, we will record in the revenue in March itself. That is called as the realization concept. See, no future income is considered, and goods sold on approval will not included in a sales. Why? Because we are not sure whether a goods sold on approval, whether the receiver will receive the goods or reject the goods, right? Because see, for example, the Flipkart is having policy, right? That is called once you got the delivery, you can either accept or reject the base depending on the condition of the parcel you are receiving, right? So if you deny it, then in that case, that goods sold on approval will not be included into the part of sales, right? Remember, in case of realization, one thing you only remember, in case of realization concept, revenue is recognized when it is earned, and not we have to not wait when the payment is received. Means they receive the payment, we should not wait. Once the earn, it will be recorded. Okay, for example, goods sold in March, payment received in April. We will record revenue in March itself when the goods are sold. Okay, with respect to the dual aspect concept, what is the dual aspect? See, every financial transaction has a two effect, right? In the book of account, for example, that is what the debit and credit. See, everything there is a one. If there is a debit, obviously there must be the credit. It is called as the dual aspect concept. Okay, for every transaction there has a two effect, two aspect. One is a debit and another is credit. For example, see, if a firm borrow 1 lakh rupees, right? So that 1 lakh rupees will be the asset. So asset value will increase by 1 lakh. So total asset will increase by 1 lakh. Very simple. And liability means what? The loan payable also increases by 1 lakh. That means for every aspect there is a debit and a credit, right? So what I have to say, the dual aspect concept simply says that for every debit there must be the credit. For every debit there must be the credit, right? If your assets are increased in the same way, your liability should also increase. That is what there must be the debit and credit. So accounting equation says that asset is equal to capital plus liability, which we have already done, right? So what is the dual aspect concept? Dual aspect means if there is a credit, there must be the debit. It is what? Simply the dual aspect concept, right? Every transaction has a two effect. One is a credit and one is debit, right? When we learn about the double interest system, that time you will get better idea about the dual aspect concept, okay? Meanwhile, you just learn about the theory part. Dual aspect concept means debit and credit simultaneously. Historical record concept. So what is historical record? Simply a transaction is usually recorded after it happened. So you cannot record the transaction in advance. For example, if tomorrow I am coming to your shop to purchase something, you will record? No. Only tomorrow when I come to your shop and purchase and give you the money, the time only you will record. That means what? Transactions are recorded only it happened, not in advance. So therefore, a business can record a sale of a goods only after it happened and not on the promise of selling in the future. Okay. So no promise in accountancy, only the facts. Next, accounting concept at the reporting stage. So what are the accounting concept at the reporting stage? First is the going concern concept. So what is going concern? See, going means what? It will continue to go for a longer period of time. It is called as going. It is going, ongoing, going on years on years. Okay. So it states that a company will continue to operate in a future and it will not close down soon. For example, Reliance Industry. So anybody can say that Reliance Industry will close down? No, because we have to assume as accountant that Reliance Industry will continue to operate in the future years. Okay, this is what simply the going concern. Going concern means what? We will assume that company will function for several years in the future. For example, if a company, for example, say Google, it is expected to continue for next many years, right? So it is what? Simply the going concern concept. Okay. So when we prepare any balance sheets, profit and loss account statement, we will not think that at the end of the year or at the end of 31st March, we will close down the business. Okay. No. For example, if accountant of the Reliance Industry is preparing their financials, okay, for 31st March. So whether they will prepare like that on 31st March, we will close down the business and we will distribute the profit. In that, whether they will prepare? No, they will prepare in such a way that whatever the profit we are having, we will keep some part for the expenses in the next few year, for repayment of the loan for next few year. That means what? We are thinking that the company is going concern. It will operate for the next few year. In that way, we will prepare the account statement. It is a going concern. Now, matching concept. What is matching concept? See, expenses should be recorded in the same period as the revenue they help to generate. What do you mean by it? See, for example, you'll get better idea. If a company earn revenue in March but pay employee salary in April, salary should still be recorded in March itself. Means what? Employee worked in March and they got a salary in April. Whether it is true? It may happen in banks. We are getting the salary in the same month, but in company for a March salary they are getting in April. Still, while doing the entry in the book of account, we have to record that these salaries spent given in April. Still, these are for the purpose of for the month of March, right? Means what? For example, I have spent 10,000 rupees in the marketing for the purpose of marketing, right? In the month say March, and in the March I earn say 1 lakh rupees, right? So against that 1 lakh rupees earning, I have to mark the 10,000 spending in the same month for the marketing. Means what? Whatever the expenses we are doing in the same period, whatever earning we are getting, that should we have to mark in the same period. Okay. So expenses should be recorded in the same period as the revenue they are helping to generate. For example, I have spent 10,000 rupees in the March for the marketing and I am generating the additional revenue say 1 lakh in the same month. Then the expenses and the revenue should be marked like the same period, that is the same month March. Okay. So deferred revenue expenditure concept give rise to this is very, very important for exam point of view. They will ask you which of the following concept give rise to the deferred revenue expenditure. What is deferred? Deferred means delayed. Deferred means delayed or later on we will pay. For example, I have to pay a light bill. Okay, on 6th I received the light bill. Okay, and they are offering me, if you pay by 18th you will get 10 rupees discount, 10 rupees. Yeah, and then 24 is the last date. Okay, and if you pay in next month also, no problem, right? Some additional 10 rupees they will charge. That means what? If I pay on 6th when I receive the light bill, okay, I can pay on 20th or I can pay in next month. Okay, they will not cut my electricity. That means what? I am deferring to do the expenditure. Okay, so deferred revenue expenditure is due to the matching concept. Is very important for exam point of view. They will ask you in the examination that deferred revenue expenditure concept arises due to the which concept. Okay, it is due to the matching concept. Next is the accounting period concept. Is very easy. What is accounting period? Generally we are very much familiar. We follow the April to March. We follow April to March, 1st April to 31st March. We follow this accounting period. Okay, so the financial statements are prepared for a specific period, say for a month, quarter or the year. For example, a company record all the income and expenses for the financial year, and in India we are following the financial year from April to March. April to March. In some developed country like USA, they are following calendar year, like January to December, they are doing preparing the financials. Okay, so whatever accounting period we are following, we must follow this the same for next years. Okay, it is not like that for 1 year we cannot decide at your own, right? We must follow the same accounting period. In India we are following the April to March. Very easy. Now main the convention of accounting, we have to see some convention of accounting. Convention of full disclosure. Convention of full disclosure is also called as the full disclosure concept. Okay, now see, the financial statement should include all necessary information without hiding anything. See, full disclosure means what? You have to disclose all the data. You should not hide anything, right? For example, a company has pending lawsuit or the legal dispute. They should disclose that in their financial statement, right? So if they disclose in their financial statement, obviously their shareholders, the bank, everything who are interested, they will come to know about the legal dispute or the law, and they will decide their action. That means what? A company should not hide anything. They must disclose all the detail. Next, convention of materiality. What do you mean by convention of materiality? See, all the material information must be recorded. Do not record the insignificant item. See, material information. For example, see, through example, you read idea. Suppose the Reliance refinery is producing the 10,000 ton oil per day, and there is one accident, and due to that, the loss of 100 kg of oil is happened. So whether we need to record that? No, because it is very much less insignificant with respect to this, right? So the insignificant information we should not record. Only the significant information we should record. That is called as the material information. Only we should note into the book of account. For example, paisa should not be recorded, right? Because which is insignificant with respect to the huge amount, right? That's why you can say only amount in rupees we will record. Okay. So in that way, this is simply convention of materiality. Next is the convention of conservatism. It is very, very important. Conservative. What is conservative approach? Means conservative. You should be conservative. Means what? I am spending very less. I am conservative. It's you might be heard that word conservatism. Means what? I am not open to anything. I am a conservative approach. So what is conservatism concept in accounting? See, what means what? Conservative means what? See, all the possible losses must be taken into consideration, while all anticipated profit should be ignored. What do we mean by that? Means if the probable losses we will record into the book of account, we will record, right? But the probable profit we should ignore, right? This is what the meaning of conservatism, right? So probable losses we will record, but probable profit we should not record. Okay, this is what the simple meaning of principle of or the convention of conservatism. See, through example you will get idea. If the value of the stock decreases, the lower value should be recorded. But if stock value is increases, we will not record until we sell that stock. Meaningly what? The lowest value we will record means what? We should ignore the anticipated profit. We will record the possible losses. Okay. This is also called as the principle of prudence. That is very important for exam point of view. Which of the following convention is called as the principle of prudence? So the conservatism concept or the convention of conservatism, it is also called as the principle of prudence. See, through example, you will get better idea. If a company expected a loss from the lawsuit, it should record it immediately. But if it is expecting a profit from the deal, it should be only recorded once it is confirmed. What do you mean by it? See, if you are a company and against your company the court case is going on in the court, right? And for that purpose you have kept aside a 50,000 rupees, right? But what happened in the case one, that the court is very favorable to you and decision came into your favor, and court says that you no need to deposit or make a fine of 50,000 rupees. You no need to deposit 50,000 as a fine. So the 50,000 you have saved, but you should not record it as a profit. Okay. And in another case, it may happen that court may order you instead of 50,000, you deposit a fine of 1 lakh rupees. So it is against you. So that 50,000 additional you have to pay to the court, that must be recorded as immediately as a loss. Got it? So the probability is also called as the contingent liability. It is contingent liability. It is also called as the contingent liability. Okay. So the company expect a loss from the lawsuit, it should be recorded immediately. But company is expecting any profit from the deal, that should not be recorded, or that only recorded if it is confirmed. Okay. Very easy to remember. For example, you will get idea, right? Your company court case is pending. Court ordered in your favor, it is profit for you, but you should not record it. Court not ordered in your favor, court ordered a more fine on your company, so you have to make provision as a loss. Okay. So simply this is the convention of a conservatism. Okay. Also remember one word here, contingent liability. Contingent liability. Okay. Convention of a consistency or consistency concept. So what do you mean by consistency or the consistency concept? It is very simply, whatever the company using accounting method, that should be continue for next year or the several year. Okay. So the company should use the same accounting method every year for accurate comparison. Okay. For example, for a first year, see, there are different methods for the depreciation. If a company is calculating the straight line method for 1 year, that should not be changed for another year unless there is a valid reason. Okay. That means what? Whatever the method, whatever the technology you are using, generally the methods, right, you are using, that must be used for next years also. Generally, unless it is a valid, there must be the valid reason to change it. Okay. That is what that means. What we should follow consistently only one principle. That is what the convention of consistency. So it is very much applicable in with respect to depreciation. For see, because in every depreciation method we are having straight line depreciation method, written down value depreciation method. So once you started using one, that must be continued to use for next year also. Otherwise the calculation may differ. Okay. That's why you can say we have to follow same method in accounting. Convention of consistency concept. Okay. Next is the what we have to learn about the interest system. See, basically there are two types of accounting, single entry and double entry system. Okay. So what do you mean by single entry and what do you mean by double entry accounting? Okay. Now see here. See, what is a single entry and double entry? See, currently which we are following? Currently we are following the double entry accounting, right? Double entry. So where the double entry system originated, it is originated in Italy, right? In a previously we learned it, right? So what is single entry system? See, single entry system is time saving, economical but not accurate, and only partial recording of transaction is done in with respect to the single entry system. In single entry system, only personal accounts and cash are recorded and other accounts are ignored. Okay. So different type of account we are discussing in the next chapter. Okay. However, only remember here for sake of instance, in single entry system is having limited use of accounts. Okay. So example, understand how it is appearing in the book of account. See, there will be the date, the particular for what we are doing the transaction, debit amount, debit reason or debit account, and amount. Okay. For next, what is the date, what is the particular, which account we are crediting, and how much amount we are doing. That means what, in simple way, there will be a single entry system, very simple. However, see, through example you will get here another example. Building a loan on that date, expenses incurred, remaining balance is this. Next, utility you have purchased, remaining balance is this. So in that way, simply it is very simple system, single entry system. Okay, so that's why there are a lot of drawbacks. It is easy, that's why time saving, economical because less complex, but it is not accurate. That's why we are following the double entry system. So what is single entry system? For example, I am having 5,000 rupees as opening balance, but I have purchased the pen for 100 rupees, so I am remaining with 4900. I have sold the pencil, right, and I earned 200 out of that. So the end of the day, my balance will be 5100. So this is what the single entry system, very easy, right, but it is less accurate. That's why we are moving to the double entry accounting system. Now in case of double entry, it is also called as the dual aspect system. Means what, it is for every entry there is a debit and a credit. For every transaction, one account is debited and another account is credited. So that is called a double entry. Double entry means what, double debit credit, right? It is more scientific. Now if you are worked in a bank as a cashier, right, or as a clerk, if you sit anywhere anytime in the cash, you notice one thing. If a customer given you the cash, you are sitting into a cash counter, customer has given you the cash, right? What happened when you do the entry, right? Customer's account get credited at the same time. Second leg will be there called as the cash leg, cash on hand leg, or the teller leg, that is called debited, right? When you deposit money, when you are making the cash receipt, right, customer's account got credited and other leg will be automatically there, cash on hand, teller, that will be debited. That means what, for every entry there is a credit and there is debit. For every entry there is credit and there is debit. One account is debited, other account is credited, right? Through example you will get, for example, you are there, right, see, through example you get, see, we are supposed to learn all the detail, how to do the entry, how to do the ledger entry, all the things we are doing here. Just learn the meaning of the concept. Okay, now see, for example, limited account, there is one company B Limited, right? If its account is debited in the because they have withdrawn the cash, so their account will debited and cash account will be credited, right? For example, you purchase some machinery, right? So machinery account will be debited at the same time, same amount in the cash. It is the transaction happening, so cash account will be got credited, right? You have received the rent. You have received the rent in the cash, so rent account will be credited, and you are receiving the cash account will be debited. Okay, so these are the basic thing. What you have to understand, what, that for every transaction there is one credit and there is one debit, and then only it will be matching, right? So always remember, for every transaction there is a debit, there is a credit, called as the double entry system. Okay, so how and which account to debit, which account to credit, that we will see in detail. Don't worry about it. Now, what are the merits of double entry system? So obviously, for every transaction there is debit and credit. So it keep a complete record of business transaction. So both personal and impersonal accounts are kept into account. However, there is limitation with respect to the single entry. It provides a check on the arithmetic accuracy. Why? Because for debit there is must be the credit entry. So automatically there will be the arithmetical accuracy. The detailed profit and loss account can be prepared for a given period of time. So simply, you just imagine the passbook you are having, right? Customer's passbook page, right? There's a particulars, the debit, the credit, and the remaining balance, right? In that way, it is they're like, so at any point of time, you can say what is my balance on 31st, what is my balance on 2nd, what is my balance. So looking only into the passbook. So at any time, you can create the profit loss account statement. It is possible to compare purchase and sale, expenditure, income, because debit entries are different, credit entries are different. So at any point of time, you can compare purchase versus sale, income versus expenditure, etc. The balance sheet can be prepared at any point of time because we are having the chronological order of transaction. Prevent fraud, and frauds can be easily detected, right? Because for every debit there is credit. So accurate details of account can be easily obtained. So these are the very easy merits of a double entry system. So friends, we have to see the accrual and the cash basis. So see, what do you mean by accrual basis and the cash basis? See, through a comparison, you will get idea. So simply you tell me one thing. In banking, what we are following? In banking, remember, we are following the accrual basis. Why? See, if a loan account is, if we open the loan account of customer, right? So we, at the end of the month, at 30th of every month or 31st of every month, we debit the interest to that loan account, and that interest is credited to the income of a bank's account, a bank's account's income, right? So means what? We are not waiting whether customer is supposed to deposit money, whatever the interest we are debiting to the loan account, right? That means we are following the accrual basis. See, through comparison, you will get idea about cash and accrual. So in a case of accrual basis, revenue is recognized once earned, right? Once the product or service is delivered, we will mark whatever the revenue it is as earned. But in case of cash basis, revenue is recognized after the payment in cash has been received. For example, I am the seller and I have supplied some goods to the my customer, right? On a credit, right? And I have to suppose to get 50,000 rupees, right? But I am sure that my customer will repay it. I give it to him back to me, right? So I will mark that 50,000 as my revenue in case of accrual basis today itself, right? In case of cash basis, I have given a customer some goods on credit, but he say that after 2 months I will give you the cash. So after 2 months I will record it at in the my books of account as a profit, right? So it is called as the cash basis. So cash basis means when the cash is practically received, that time we will mark it as a revenue recognition. But in case of accuracy, once earned, we will mark it as a revenue recognition. Expenses are recognized once billed, and here in cash basis, expenses are recognized only when the cash is spent. So cash basis means when the cash particularly handover is done, at that time we will mark it as a recognized. But in case of accrual basis, once you receive the bill, for example, you receive the electricity bill on 6th of the month, on the same day you will have to say, you have to make a part. You, for example, you received a 1,000 rupees as electricity bill on 6th of the month. On the same day you will mark a 6,000, you will mark less whatever the cash you are having, because you have to say as a payment, you have to payable, you have to mark it as payable. Okay, so whatever the expenses that you have to recognize once billed, means once you receive the bill, automatically you have to debit it from your whatever the balance you are having. That means you have to kept it separately into the account payable in future account. Okay, so simple thing. What is the meaning? Accrual means if you receive simply bill also, you will decrease that amount from your profit. In cash basis, when you pay it practically, on that day you will record it as a spent. Taxes are paid on accrual earning. Here we are recording the profit, obviously we have to pay the taxes on the same. Here if you pay the cash, or after that only you have to pay the taxes on it. Okay, not only once you receive the bill. So example, you get idea. If the company sell good on credit in December and receive the payment in January, the sale is recorded in December itself. Why? Because we are following the accrual basis. Means the month in which we are doing sale, in the same month we will record the revenue. However, in case of cash basis, if companies sell a good on a credit in December and receive the cash in January, then we will record the sale in January. Why? Because in January we are receiving the payment. So it is very, very important to note is simply selling month is recorded as a revenue in case of accrual basis. However, the payment in which month you are receiving, that is recorded as a revenue in the cash basis. Okay, so two things. In case of accrual basis, when the sale is happening, that is important, and in case of cash basis, when the payment is receiving, that is important. Okay, so just to compare and you can easily able to recognize it. Okay, so friends, here we will stop. You can subscribe us on the YouTube Banker Zone. You can join our Telegram group Banker Zone JAIIB on Telegram. There is application available at the Play Store, Bankers Zone JAIIB, which you can easily download for the complete course. Thank you, friends.